Right, good morning, ladies and gentlemen. Always great to see you all back on Boutiques on Wednesdays, and a warm welcome. Also, I'd rather say a freezing welcome, especially here in Pretoria and Joburg. There are economies outside the US showing market momentum as the US dollar slows, and we are seeing assets moving to other developed and emerging markets economies. But you can't ignore the US. By way of example, if you look at companies like Microsoft with a lot of earnings ex-US are benefiting from a weaker dollar. What to do? On the local front, the rand is improving, and despite slow growth or economic growth, there are a number of companies in SA still doing very well. How do you deal with global asset allocation, and are there still some companies that can offer investors exceptional investment outcomes? Here to unpack some of this and more, it's my pleasure to welcome our presenters for this morning. A man that needs very little introduction, Nick de Vos from Centaur Asset Management, speaking to how they identify such investment opportunities at Centaur. Good morning, Nick. How are you doing this morning?
Good morning, Eugene. Well, thanks, and you?
Very well, thank you. Nick will be followed by two gentlemen from Northstar Asset Management, Donovan Stefan and Sebastian Holzbach, looking at the Northstar Global Flexible Fund and the current asset allocation views. Good morning, Donovan. Good morning, Sebastian. How are you?
Good morning, Eugene.
Morning. Thanks for having us.
Gentlemen, thank you all so much for joining us this morning, and thank you for your time. We really appreciate it. Nick, you're up first. You can put your presentation up when you're ready. We'll go through your presentation. You'll be followed by Donovan and Sebastian. To our audience, you know how it works by now. Q&A bubble. You're more than welcome to post questions on whatever matters you want to raise with our presenters, and we can see how many of those questions we can deal with. Nick, thank you very much. I'm not going to take any more of your time. The floor is yours, sir.
Okay, great. Just checking, can you see my screen?
Perfect.
Okay, great. So good morning, everyone. Thanks for joining us this morning. My voice sounds a bit odd. Been battling a flu for the past couple of days, so apologies. So essentially today, title of the presentation is Backing the Jockey. What I'm really going to be talking about is how new management can come into good and bad businesses, turn things around, and how that can lead to exceptional investment outcomes. Firstly, just a quick business update. Sure, all of you are familiar. Business was founded over 25 years ago. There are founding principles. We've got just over 11 billion rand in AUM. And then over the past 18 months, we have hired 4 new people into the overall business. We've got a new Chief Operating Officer, Doug Stott. We've got hired a new person in client services, and also 2 new members in the investment team. One joined this week. So the investment team now comprises just over 60% of the staff complement at Centaur. It's also a very simple business. We only have 3 unit trusts. We've got a flexible fund, which is great for discretionary funds. We've got a balanced fund for Regulation 28 compliant investments, and then we have an SA equity fund if you want to take a bet on the SA equity markets. So just firstly, something that we really like to focus on at Centaur is the business model. We want to buy businesses who really have a profit protecting ability. These aren't the businesses that we always buy, and that's really well focused more on the presentation today. But just to give you an example, kind of like right at the top of this list here, we've got a business like Microsoft. That's probably one of the best businesses in the world. They really own the standard. You know, just some simplistic example, I'm busy presenting to you on PowerPoint. I'm sure all of you are running Microsoft on your PCs that you're watching this on. Excel might be integrated into your businesses, and you know, if tomorrow Microsoft decides to essentially double their prices, there's actually very little we can do. And just out of interest, Google offers a very similar product to Microsoft Office, and they charge essentially nothing for it, yet no one uses it. So it just gives you a sense of how strong the Microsoft business model is. And if they don't meet their budget in any particular year, then that pricing is a very, very easy lever for them to pull. Versus right at the bottom, you've got a business like Sibanya. It's actually a business that we've invested in the past and did very well out of, but it's a high-cost commodity producer. They really have essentially no cost or control over the product that they produce, and they've got very little control in terms of the costs that feed into the business as well. So 2 examples that I want to give you just to set the scene of what were very bad businesses but turned out to be great investment outcomes. And it's 2 examples, businesses that everyone will know very well. But firstly, you can clearly see AI generated the slide for me. Made a spelling mistake there, right at the bottom left-hand corner, textile business without the E. But on the left-hand side, if you think of a textile business, it isn't a very high-quality company. They are kind of susceptible to various cycles. They essentially sell a commodity. It's a very easy business to replicate or for other people to do. It's not that scalable. It's not like a platform business where you can just add more users to it. You have to build new factories if you want to scale it. And you're essentially selling a commodity that you've got very little power over. And you might have guessed it by now, but the textile business is Berkshire, where you had phenomenal capital allocators, Warren and Charlie, over a 60-year period, compounding at 20% per annum. Now, that's absolutely the exception. And then on the right-hand side, you've got a printing and publishing business that all of us here in South Africa would be familiar with. What might have been a very good business 25 years ago, over time, as digital has come along and people are consuming media more through digital means, the quality of the business would have deteriorated as less and less people willing to pay for that. But Koos Becker made a phenomenal capital allocation decision, bought company Tencent. I think probably the real masterstroke there was not selling the stake in Tencent and holding it for such a long period of time. And that one compounded 22% per annum over a 25-year period. But again, that's the exception. So bring it back to, I guess, like closer to home now. So if we look at the cement industry, and the example that I'm going to talk about today is PPC. So I've got 2 time frames here. So the 2020 period, really in 2020, cement was a commodity, and it still is a commodity. These businesses have little to absolutely no pricing power. There were 6 primary players in the market back then. Still the case today, 6 primary cement players, but the difference, we do have the Chinese starting to enter the market. Currently, there is a Chinese player looking around, potentially trying to acquire one of the operators. The industry back then was overcapacity. Importers and blenders were around, and it's still the same case today. In 2020, there was a bit of a tailwind from demand. You had that whole home renovation boom where everyone was locked down at home, and they took up hobbies like baking, and everyone decided to, while they're sitting at home, to renovate the place. And then maybe what's changed today as well is that we have one of the operators, Lafarge, was bought by Afrimat. They're bringing more volumes into the market, so that's a negative. And there is essentially little to no growth over this time period, 2020 to 2025. So in summary, there's fierce competition, sluggish demand, there's overcapacity, and there's no pricing power industry. So you would think a horrible industry to invest in. So if we look at how PPC has performed over this time period, well, it's gone up 10 times. And it operates in a very tough space. There's been 2 new CEOs over this period. The first CEO that came in, Roland, essentially his job was to stabilize the ship. We bought into PPC expecting a rights issue. I think that tailwind of the home retail demand really bailed them out. So they avoided a rights issue, and they sold some of their assets in the business at exceptional prices, particularly the DRC, and they essentially right-sized the balance sheet. And then more recently, more of an operator has been appointed at PPC, Matthias Godelli. He joined in December 2023, so he's been in the business for essentially 18 months. And over that time period, their margins have gone from 12% to 16%. And remember, this is in an environment with no growth. So he's taken a lot of costs out of the business. They're really focusing on their manufacturing efficiency. I think there's still a lot of levers still to pull there. They're looking at their route to market. And for the first time, it feels like in a long time, PPC is really on the front foot. So you might have seen in the news that they've announced an investment in the Western Cape. There's a 3 billion rand plant that they're going to be constructing here. And it, by all accounts, should be the lowest cost integrated cement plant in the Southern Hemisphere, which will be a competitive advantage. So, tough industry, not the best business, but something with the right management, pulling the right levers, turned out into an exceptional investment. A few other local examples. So Nampak also operates in an exceptionally difficult industry. For many years, I think quite badly run business. They were operating in regions in Africa, specifically in Nigeria, that it's very difficult to do business. So Phil Roux was appointed in April 2023. He's a market player that a lot of people would have been familiar with from his pioneer days. And he really came into the business as an interim CEO at the time, led a rights issue, the Nigerian exit, and that really stabilized the balance sheet and reset it. So it wasn't like the PPC case where they could have avoided it. Here, the business needed the rights issue. And he's really acted swiftly in terms of cost cutting and taking costs out of the business. He's renegotiated contracts with both suppliers and customers. And that's really where big problems been for Nampak. They're kind of like squeezed in the middle with no pricing powers, with multinational customers that kind of dictate terms to you. That hasn't completely changed, but he has improved their working capital cycle to an extent. And they've also simplified the product offering with all the disposals that they've done. So really now it's a beverage can manufacturer focused on that. They still have a diversified food business, which is undergoing a turnaround. But from the date that Phil was appointed, up until I pulled this, it's done over 200% investment. So it's exceptional return in that space of time. The other one, Altron. So Altron's a little bit different because I think there were good businesses within Altron. It's not the same as PPC or Nampak, which I think are lower quality businesses. But Werner Kapp came in October 22. He replaced divisional management specifically at Northstar. That's kind of the hidden gem that sits inside the business. Fintech, that's also done exceptionally well for them, doing much better than what we originally expected based on the investment thesis. Also, the theme of disposing of non-core operations. I think that's one of the things that new management can do. They come in, there aren't any sacred cows, so they are willing to cut businesses that need to be cut. And that one's also done well, 185% return since Van has come into the business. A few other local examples, Tiger Brands, Chad Kruger's come into that business, currently doing a turnaround. That one's also performed exceptionally well since he's come in. Southern Sun, myself and Olok is probably one of the best hoteliers in the country. And then Momentum Metropolitan, which is also undergoing a bit of a turn under Jeanette Marais. So the point I'm trying to make, just to step back, is that not all turnarounds work. I think there is some skill in identifying the ones that will work. These businesses that I mentioned have had attempts at turning them around in the past that weren't successful. They have had other managers that come in and don't really do the right things. And these are now just examples of where they've worked very well. But if mentioning all these businesses, I think size is a competitive advantage. Not everyone can take advantage of these turnaround stories given the market cap of these businesses. So here's just a simplistic example that we usually give guys. So if you look at Netcare, we mentioned here on the slide, that trades 50 million rand a day. It's a company we're all familiar with, large cap on the JSE. If you're running a 20 billion rand fund, if you were to build a 1% position, which is a very small position, it would take you a month to build that position. Now, ordinarily, you would probably build a 2%, so it takes you 2 months to build a position in Netcare. But also remembering, if you ever decide to sell, that's also going to take you 2 months to get out. So in the SA market, we think size is definitely a competitive advantage. And then here's just to wrap it up, Centaur's long-term performance. I'll just point out that period up until 2004, that stock portfolio's performance, that's essentially what the business was built on. And then from 2004 onwards, it's the flexible funds returns, and the initial investors with Centaur are up over 60 times on their original investment. So that wraps it up. I'm going to hand over to the other presenter now.
Many thanks, Nick. Donovan, you are welcome to start sharing if you're ready.
Cool. We're going to share the screen now. Great. Can everyone see the screen?
Perfect. Thank you so much.
Okay, great. Good morning, everyone. It's a pleasure to be here with you and to get the opportunity to talk about the Northstar BCI Global Flexible Fund and share some insights with you. So I think what we know is that 2025 has been a very eventful and active year for the fund, and I'm really looking forward to sharing what we've been up to over the year. And yeah, so before we get into that, I'd really like to take a step back and think and reflect on the broader market, because I think what we know now is we're operating in a very, very dynamic market and an uncertain world. And I think what we really need in this kind of environment is adaptability and flexibility, but within a robust investment framework. So yeah, so this chart, I just want to reflect on the market, and this chart shows you the asset class returns for various asset classes. And what we have here is the 3-year annualized return to the end of December, as well as year to date. And what we can see from this is that the one consistency over the shorter and longer term is that gold has been the best performing asset class. And over the past 3 years, we know that equities have outperformed both bonds and commodities. But when you dig a little bit deeper into that equity performance, we can see that over the past 3 years, it has really been driven by US equities. And if you really want to go into one layer further, it's really a few stocks, the Magnificent Seven, and a few other stocks that have driven equity returns. So we can see that over the past 3 years, also that developed markets have substantially outperformed emerging markets. And what's quite interesting, that over the past 3 years, the 20-year treasury has been the worst performing asset class, which is long bonds, and it's delivered a negative 90% annualized return for 3 years. But now what's interesting is if we look at year to date, we have gold consistently outperforming. That's been the one consistency, but equity performance relative to bonds and commodities, the gap has narrowed. But what is very interesting year to date, when you look at the equity performance, it's really being driven by European equities. And actually quite interesting, US equities have underperformed not only European equities, but also bonds and commodities. So it's really, really interesting how the dynamic can shift quite drastically over the shorter and longer term. And also what we've seen of a reversal of the longer term trend is that now emerging markets are starting to outperform developed markets. Now, just to give you a flavor of sector returns, so what we can see over the past 3 years, energy and information technology have been the best performing sectors. And really, that's a function of a few things. Energy has obviously come out of a COVID low base, and that's when oil did well, subsequently in 21 and 22. And obviously we know the story with IT is that after the launch of ChatGPT towards the end of 2022, 2023 and 2024 were very strong years for IT. So those two sectors have been driving performance over the past 3 years. But now if you look on the other end of the spectrum, real estate has been the worst performing sector. And that really is testament to obviously the magnitude and the quite quick nature of which interest rates have risen, as well as you've seen a few other defensive sectors underperform. But what I find very interesting is that even though in the 3-year performance you see energy and IT at the top, within that the market dynamics have shifted quite drastically in the short term. So for example, in 2022, IT was the worst performing sector, and defensives performed well. But then in 23 and 24, we had IT have good years, and you've had your defensive sectors like healthcare staples perform poorly. And now sitting here year to date, it's actually the reverse, where IT has been one of the worst performing sectors, while the defensives have done well. And then lastly, I really just want to look at the currency returns, and what we know over the past 3 years, really it's been the dollar has been king, and it's outperformed pretty much every other currency. But what we do see year to date is that trend has really reversed quite substantially, and you've seen a lot of other currencies, pretty much all major currencies developing and emerging market currencies outperform. So really from these 3 slides, the core takeaway I want you to leave you with is 2 things. One is that the market dynamics shift quite quickly. So the market isn't static. You really need to be on top of things and have a good process. And secondly, flexibility. The one way not only to survive, but to thrive is having flexibility within a robust investment framework. Great. So now what I want to really talk to you about, I'm just going to put this all up, yeah? So now I really want to give you an idea of how at Northstar our investment and research process works with all companies in our portfolio. So really to kind of give you an idea, we start in the middle of this presentation. So if you can draw your attention to the middle, yeah, this is the global buy list of 100 companies. And really to tell you how we get to these 100 companies, it starts off by looking at over 2,000 companies in the MSCI all country world. And what we do is we narrow that down to a stable universe of 250 companies of the highest quality. And really, these 250 companies give us deep market insights and a good foundation for good investment decisions. But not just how we look for companies with high returns on capital, we also want to maximize our return on research. And that's where we focus on 100 companies in the center of the buy list. And really, we see the buy list as central to all our decision making because it combines the collective wisdom of our whole investment team. And that really directs us with what to invest in. And that's why we see it as the brain of our portfolio. So now just to talk a little bit, if I can draw your attention to the left-hand side where you can see there's the risk. So this is how we define risk. What we do is we do deep fundamental research across 4 buckets, which is moat, management, ESG, and industry. And they're all equally weighted to give us a score out of 100. And what this tells us is it tells us the maximum weight we can have in a company. So for example, if I can draw your attention to the bottom, a low risk company can be as much as 8% in the portfolio, whereas a high risk company all the way at the bottom can only be a maximum of 2% in the portfolio. But now when that's one part of the equation, obviously return is the other part of the equation. And what we do for there is we have deep fundamental valuation models for all 100 companies in our portfolio. And really that helps us determine at what price we want to buy a company, because our aim is to buy companies at intrinsic values below at what they are currently trading. So really to tie it together, what we want is we want to define risk, and that tells us the maximum weight a company can be in the portfolio. And then we also want to have a return portion, which then helps us with the timing and size that we want to purchase in the company. And that really helps us allocate capital efficiently to deliver the best risk-adjusted returns. So now with this slide, I'll take some time just to explain it to you. This really is the outcome of our research process and our buy list in this slide. So what this slide shows you is the evolution of our intrinsic value discount over time. And what this really is interesting about this is that it has been a very good predictor of future market returns. So let me just start at the bottom. If you look at that red zone, that is when the returns on our buy list are very low. And in the middle portion, it's when returns are moderate. And at the top green section of this chart is when the returns are attractive from a bottom-up perspective on our buy list. And having applied this process for now over a decade, what we have seen is we've collected a strong data set over that time and we've back tested it thoroughly. And what we've seen is that when returns are in certain ranges, it's tended to be a very good signal for future expected returns. And more recently, over the past 5 years, we've had a couple of good entry and exit points, which we've managed to execute because of this investment process. For example, just 3 months ago, if I can draw you back to that, the intrinsic value discount on our buy list was roughly 16%, which was in line with our long-term average. And at that point, our equity weighting was in the low 60s%. And then what happened is very quickly, the intrinsic value of our discount on our buy list surged to over 28%, obviously on the back of Liberation Day and tariffs. And in that moment, we were able to increase our equity allocation by over 10% in a short space of time. And that's really testament to having flexibility and trust because we have a robust investment process. Now, if I can basically just 3 months later and to kind of give you insights on where we are currently. So after that big surge in the buy list returns, we added equity. And now returns have subsequently reduced all the way to 16%, which is roughly in line with our long-term average. And what we've been doing is reducing equities and following the process. And even when you look one step deeper, because we have such a deep, in-depth buy list, we've looked at where that 16% returns are coming from, and it's really concentrated in a couple of stocks. So for example, just 10 stocks on our buy list are accounting for almost 67% of that return. Which is quite indicative of our future returns we expect to be quite diminished. And if we look at just our breadth of our 100 stocks on our portfolio, 44% of those stocks are exhibiting negative returns. So really at this point in time, we're not seeing a lot of upside and future returns are probably expected to be low for clients. Great, I'll now hand over to my colleague Seb, who will talk to you about the fixed income portion.
Awesome. Thank you so much, Donovan. And thanks to Eugene and BCI for hosting us. Just a quick introduction. I'm Sebastian Holzbach, and I sit on the fixed income team that is headed up by Mark Seymour. So we run the Northstar Global Income Fund, the Northstar Local Income Fund, but we also have responsibilities over fixed income in the Global Flex and in the Managed Fund. So let's talk about, let's set the scene for global fixed income. So currently the global fixed income landscape has changed drastically over the last 5 years. The zero interest rate policy area, so where central banks set policy rates near 0% is over. And this period brought us low real yields, flat nominal curves, and in some cases even negative yielding debt. So these aforementioned dynamics are a thing of the past. And currently, as shown on the slide, the 10-year US Treasury is exhibiting a real yield that was last on offer in 2015. So finally, it looks like fixed income is back to being investable again. Curves have uninverted and steepened, and term premium is now being priced in. Therefore, investors are starting to get adequately rewarded for the risk that they're choosing, that they can choose to take. The next slide shows the relationship between the yield levels on the US the 10-year Treasury and the subsequent 3-year annualized returns. What we can observe based on historical data is that when you take a position in the 10-year yield, or when you take a position when the 10-year yield is elevated, this leads to greater returns over the next 3 years. So currently, with the US 10-year yield at around 4.25 and trading in the range as displayed by the blue box on the chart, we see this as an attractive entry point with regards to the returns that one could expect over the medium term based on this historical data. And one thing that I think is important just to note lastly, in terms of setting the scene, is that the addition of fixed income now, especially into a flexible fund, can offer both the value of added diversification as well as a real return component. And this real return component is something that has been lacking in the past. So we believe that this is most welcome in the current economic climate. But yeah, let's look at how we see opportunity in more detail. And we'll take a look at our US Treasury curve valuation framework with a 3-year investment horizon. So what you can see on the graph now being displayed is the current US Treasury curve with our bull, bear, and base case curves being overlaid. So these valuation curves are built out by taking 3 inputs into account. That is the path of interest rates, structural inflation, and then we impose real hurdle rates at the long end. These input assumptions are debated each week in the fixed income meeting and are informed through a scrutiny of economic data releases, monetary policy decisions, and political events. Furthermore, our views on growth, labor market strength, and regulatory policy will also filter into these valuation assumptions. So what do we do from here? What we do is we migrate the current yields on the curve to their respective exit yields in 3 years' time, as formulated by these bull, bear, and base case valuation curves. And what this does is it generates an annualized return for each tenor across the curve in a bull, bear, and base case scenario. So the next slide contains a bar chart of these valuation results. So from here we can assess the relative value across the US Treasury curve, as well as compare it to expected cash returns on offer. So if we just look at this chart very briefly, our current valuation points to expected returns in the 3, 5, and 7-year point, slightly beating cash, but with much less risk if you were to look at the spread between the bull and bear expected returns. One can note that going long out in the curve, the 10, the 20, and the 30 year, looks like you could generate higher expected returns in a base case. You'll be taking on a lot more risk, and this is shown by the spread between our bull and bear case valuations. So what this process is, it's very consistent, robust, and structured. It allows us to highlight the relative value more clearly, and also navigate yield ranges more effectively. Moving on to asset allocation. So our monthly asset allocation optimization process distills our fundamental valuations and also further refines our investment process. At Northstar, we cover a vast majority of asset classes, and we draw on the full investment team in order to formulate 3-year expected returns for each asset class. What we do is we put these expected returns together with historical asset class data, and we optimized for the best risk-adjusted return profile. And this is done for each fund. Looking at the Global Flexible Fund as an example, and at the recent optimization and the outputs from that optimization, I want to draw your attention to the dot plot on the right, which shows an efficient frontier as a result of 1 million portfolios being generated with randomized weightings across the asset classes being used in this particular optimization. The pie chart on the left depicts the best risk-adjusted portfolio that was chosen in June for the Global Flexible Fund. So each month, the Asset Allocation Committee meets to assess these optimization results, as well as assess the current positioning of the fund with respect to the optimized asset allocation. Thank you for your time. I'm going to hand over back to Donovan, who will conclude with the presentation.
Great, thanks, Sebastian. Okay, great. So these next few slides, really, I just want to highlight how flexibility, when grounded in a robust investment process, can lead to good outcomes. So what you can see on this slide is that the Northstar Global Flexible Fund, since inception in 2017, has consistently outperformed its peer group. And what's pleasing to see is that this fund has outperformed through various market environments. Now, just looking at it in this form, so what we can see, that's 2 things. One, the Northstar Global Flexible Fund gives you consistent outperformance. And really, since inception in US dollars, we've almost doubled or over doubled the return relative to peers. So this is really a function of having a robust investment process and really flexibility, as Seb spoke to, across asset classes. And then lastly, one of the core kind of foundations of our good performance in a flexible fund is having good equity stock selection. So what you can see is that our equity portion of our Northstar Global Flexible Fund has a track record of over 13 years. And over that time, it has consistently not only outperformed large cap equity peers, globally, but also the MSCI World consistently over time has outperformed. And really, this is, as I said, and want to leave you with, is really testament to having flexibility and a robust investment process. And I think that's ever more so needed in the current environment going forward. Great, that concludes the presentation. I'll hand over back to Eugene.
Donovan and Sebastian, thank you very much for that. I've got a couple of questions from you. I'm going to start with you. I know Nick is still on the line. Nick, I'll come back to you in a second. But while I've got you on, if we can maybe just talk to things like regional allocation. And yes, I mean, it's about where company earnings are generated, not necessarily where companies are listed. I think we all understand that by now. But maybe on that point, I mean, where do you find the majority of companies at the moment that's showing good potential growth in earnings? Is it companies where earnings originate more now in markets outside the US, especially that first slide that you showed, where returns came from, year to date, and that rotation away from the US, if you look at places like the EU, UK, and some emerging markets. What is that opportunity set at the moment, and where are those earnings coming from?
Great. Can everyone hear me?
Yeah.
Okay, great. Yeah, so that's a very, very good question. I mean, there's been this theme now over the past few months that everyone's spoken about, the great rotation out of the US. But what you actually seen is that if you look at a global portfolio, there's still a large allocation to US equities. So that trend, if it continues, there's a long way to run with it. But where we're seeing upside, I mean, we are very much bottom-up fundamental investors. So where we're seeing upside, I can speak to from our buy list. It is true, we're seeing a lot of upside actually outside the US. So if I can just give you an idea of where we relatively position now compared to the MSCI World Index, we actually underweight US equities by about 10%, and we overweight in our European geography by over 20%. So we really do see a lot of value coming from Europe, and where we kind of position it is across kind of the UK, Netherlands, Denmark, Sweden. So we are seeing a lot of outperformance to come from the European parts. I mean, the US, the S&P is still expected to deliver decent returns and EPS. Like for this year, I think earnings is expected to be about 9%. But remember, it's all about the starting valuation. And we know that the S&P is trading just over 20 times, which is relatively high compared to history. And for earnings growth, that is really below average to average. Whereas in Europe, you're seeing valuations much more attractive from a top-down level and from a bottom-up perspective on our buy list.
And I think it's something a lot of us struggle with is global allocation and how to allocate to that, the global equity carve out. And I mean, the flexible fund is maybe a good opportunity to address a lot of that. You're not buying necessarily a tracker, and you've showed that active managers can actually outperform the MSCI all country or the world index. Sticking to global equity, announcements again yesterday coming from Trump that he's sticking to the tariff deadline of 9 July. And some deals are being made, but a lot of deals are not being made. Do you think this is maybe going to shake the tree again? And with new tariffs retaking and impacting on global earnings?
Yeah, so that's a very good question. I wish we had it. I mean, I think we would be very well off if we had a crystal ball to know what Trump's going to do from minute to minute. But yeah, I completely agree with you. The 9th of July headline is a big day. I mean, we've seen previously he's backed out, and that's where the acronym TACO has came from. Trump always checks things out. But I think really it's hard to know what he's going to do on the 9th of July. And it's very possible that the effects from the prior tariffs still filter through into inflation. We just don't know. It's a bit too early to speak to that. But what I really think as we look into the second half of the year, what's really going to be important is the interplay between policy uncertainty and macroeconomic dynamics. So really what we've seen, I mean, the US, there's been mega shifts in not only policy, there's been shifts in fiscal spending, there's been shifts in regulation, and really we've started to see that filter into the economy through not only consumer sentiment, business sentiment, but also in terms of market sentiment. So I really think that dynamic is going to be critically important as we go into H2. I think it's very hard to predict macro kind of trends and what Trump is going to do. So that's why we really stick to doing bottom-up fundamental investments. And we look for the best companies that actually perform well through the cycle.
Interesting indeed. Sebastian, you've showed the optimization model. You spoke to global fixed income. You've also showed it in your asset allocation chart. We can see it on your fund fact sheets as well, healthy allocation to global bonds. The one slide you had on, I found very interesting, that bull-bear base case scenario on global bonds. Where do you allocate at the moment? Do you allocate more to longer dated bonds in that bond carve-out between 10 and 20 years? Where do you sit?
Yeah, so great question. And as that valuation showed, you're getting slight outperformance over cash. And the interesting thing is that because the rates at the front end are still so high, you're actually getting real rates out of cash as well. So you don't have to step too far away from cash to get additional return. With the uncertainty in the market and what Trump's doing and fiscal spending and the tax bill that's the big beautiful bill that's going through the Senate and the House at the moment, that's going to create a lot of uncertainty over debt spending. So if you put some of those numbers into the valuation process, you do see that the long end can offer some value, in a bull case and even in a bear case scenario, but you have to be cognizant of the risk that you take. So currently, in the global flexible bull fund, we like to keep the fixed income exposure relative to the front of the curve. But I can speak in our global income fund, we have, when the 20-year and the 30-year breaches around 5%, as it did around the time of the tariff announcements, we've taken small positions in those areas, and that's just completely following the process. We're putting in the expected returns, we're putting in the valuations, and the optimize at the end, optimizing for a certain risk that we are comfortable with, is drawing us into taking smaller positions and going longer out on the curve. But currently, with the global flexible fund, we're keeping things close to cash and up to about sort of 7 years, 10-year treasuries.
In trying to understand your overall optimization model a little bit better when it comes to asset allocation, is it based on the principles of what asset class can potentially give you better returns, or is it more to do with mitigating risk, or is it a bit of both? Using bonds again as a good example in a flexible fund. And if I look at your flexible fund compared to similar funds, you've got a very healthy allocation to global bonds. Is that, do we see this as almost as a counterbalance to volatility on equity markets, or does it speak to absolute performance numbers?
Yeah, a good question. It's a bit of both with the optimization process. So, like I said, we capture the expected returns from our investment team. Then we also have a long history of asset class return data and for the various asset classes that we use in those optimizations. And what we need that long history of asset class return data is in order to generate a standard deviation profile per each asset class. So we then put the expected return and the historical risk or standard deviation that asset class would give over time, and we blend it with a target standard deviation in mind for each specific fund. So let's just say, for example, the global flex standard deviation profile is 10%. On that efficient frontier, we'll go out along that curve up to 10%, and we'll find the highest returning portfolio on the efficient frontier, dive into that portfolio and assess the asset allocation that portfolio displays, and then move from there. So you often find that even though fixed income now is giving a return, it's also helping with the diversification of the equity holding. But like I said, we've got now diversification, but then added real return. So we'll be getting sort of two benefits from fixed income at the moment, and that's why we see it as an important tool to have a flexible fund.
Makes a lot of sense. Thank you for that. Very last question. I see Nick is waiting for me. Nick, I'll come to you just now. I know a couple of attendees are going to look at your fund as a possible solution for the global carve-out. But when I open up the site and looking at your funds and your solutions, there's two global flexible funds. You spoke to the Northstar BCI Global Flexible Fund, but I see you also have a flexible feeder fund. Can you maybe just position the subtle differences between the two?
Sure, Eugene, that is a good question, especially for prospective investors. So really those two funds, first of all, just to give you an idea, is they're identical and they'll deliver the same kind of outcomes. The feeder fund is just an easier way for a South African investor to get access to the global fund. That's pretty much all you need to know on that front, simplistically. And it's rand denominated.
As simple as that, and that makes it very clear for potential investors which fund to select. Donovan and Sebastian, thank you so much. I'm going to keep an eye out on the audience if there's any more questions coming your way. But Nick, if we can maybe just touch on your flagship fund, the flexible fund that's been going for numerous years. Just in terms of your asset allocation, understanding that it's not a global, it's a SA flexible fund. So just bringing things back to the mandate of a fund, max on 45% global. What's your asset allocation views at the moment in terms of onshore versus offshore?
Thanks, Eugene. So for quite some time we've been overweight SA. So we are still overweight SA relative to offshore. So we construct our own benchmark. So just for context, the offshore weight within the flexible fund benchmark is 30. So we're running slightly under that at the moment. Locally, it's 50. We're running over that. And then that's the view we've had for some time. So lower rates in South Africa. We're 25 basis points away from what usually is an inflection in the market. 150 basis points from kind of top to bottoms, usually when SA consumers start spending. So we are positioned for that. And then there's a whole host of other things that everyone would be familiar with. So there are structural reforms on the go. Load shedding is no longer such an issue, and inflation does seem to be under control. And then offshore is very stock specific.
Yeah, does currency ever come into the equation if you look at the onshore offshore argument? And I mean, if you just look at currency movements over the year to date, the underweight offshore definitely helped. But is that something you really put into the argument when you decide on what percentage you should have local global, or was it purely based on fundamentals?
So inevitably it comes into the argument, but it's not like we're going and saying we think the rand's worth this, so we must have this much offshore or this much local. So we've got a view on the currency. You have to. A lot of the local businesses are rand hedge businesses, so it feeds into what their earnings are, and then our view on the currency might dictate if we use like a futures overlay to hedge some currency. It's not big positions ever, or if we're looking for levels to maybe take more currency overseas to buy stocks or bring currency back to buy things locally. But it's good luck taking a very strong view on where the currency is going to be.
No, exactly. Nick, coming back to SA, I mean, we all know about your SA equity fund as well. That was launched, what's it now, about a year and a half ago?
Yeah.
Doing exceptionally well, and people actually wondered, but when you launched, why SA equity? Because in that period, I mean, the SA markets were just mad, and politics overwhelmed everybody. And we thought, oh my crikey, how's the SA equity fund going to work? But it worked out exceptionally well, and your SA equity carve out in your flexible fund as well. But just on that point, I mean, we've heard so many comments on the SA listed securities, the market shrinking. There's not enough
Yeah.
opportunities. And another thing that is rearing its head, especially over the past year and a half, for various reasons, but the lack of opportunities being one of them, is private equity funds coming up all over the show. And I don't want to go into specific views on private equity. I rather want to focus on, is the SA market still big enough for clients to really have exceptional returns without having to look at things like private equity?
I think so. It depends on the size of the fund. So, I had that slide up, which gives you a good idea of how many shares we think are investable depending on the size of your fund. So, if you just think the flexible fund, 7.5 billion, but within that, SA equity is only 3.5 billion. So that's still on that slide is under the 5 billion mark. So there's probably 140 different shares that we think are investable in that fund, and then obviously a lot more in the SA equity fund that's around 800 million. But if you're running a 20 billion rand fund, then that necessitates that you need to be a lot more benchmark, kind of like cognizant, or run a lot closer to the benchmark. Otherwise, it's quite difficult to take any big views in mid caps.
So size does matter.
Size.
You need somebody that are nimble enough in the SA market. I mean, and we've seen that a couple of times. Nick, question from the audience. What is your view on Nampak given the significant recovery?
So it's had a good run, still like it. There's a couple reasons for it. So the business is kind of like the earnings that we've already seen don't include proceeds from Nigeria. So there'll be a big kind of tailwind in earnings from just the finance cost line. So it's probably on 5 times kind of like odd forward. There's also a growth story. Even though it's not the highest quality business, you've got probably 40% kind of capacity in their beverage can manufacturing. Now, I don't think they're going to fill all of that, just there isn't demand for it, but there are a couple of underlying demand drivers in SA. So you've got a shift away from plastic and glass to aluminium cans. These energy drinks, you see a lot of people drinking, that's a big kind of like demand driver. So you maybe get low single-digit volume growth, some price. Angola has a lot of upside. They still own that asset. That's only at 40% capacity. Not too long ago, it was making double the amount of profits that it's making at the moment. So you don't need a lot to change for Angola to do very well. There's a couple other things going on there as well. And then it sounds like there's still some margin to be had, especially in the diversified foods business, from things that they're doing. And actually the beverage business, even though they've done a turnaround, it still seems like assets aren't running as efficiently as what they can. So I still like it.
Nick, when you shared a couple of good examples of companies that you invest in at the moment and why you do that, but to unpack that a little bit more, just to try to understand your stock selection a bit better. A lot of asset managers will say that, meeting with management is very important to understand where they're going with the business. And you've got another school that's saying, but they totally avoid meeting with managers because they'll tell you stories that they think you want to hear, and it's not always the truth, and that the answers will rather come from the numbers in the company. Where does Centaur sit on that? I mean, do you meet with management? Do you pay a lot of attention to that, or is it really more in the numbers of the company?
So it depends on the business. I don't think going and seeing a resources company is going to give you a hell of a lot of insight. I don't think they know where the underlying commodity is going. But in kind of the more business-centric kind of businesses, I think there is merit in seeing them. But what we try and do is build our own view before seeing them, and seeing management either confirms that view or doesn't. So we don't go in there for them to tell us their view. We make our own assessment of the business.
Thank you for that. Very last question from the audience. It is well done for avoiding Sibanya. It has been a tough hold, but given where the underlying PGM basket price is today, would you sell it now or try to maximize an exit price given platinum price forecast?
That for me. Maybe I didn't explain it properly. So we've had Sibanya in the past. We don't own it at the moment. So we bought it in the previous PGM run. Yeah, I think we were up almost 10 times on it. We sold all of it in the high 70s. We haven't bought it again. So at the moment, we've got a bit of exposure to Valterra and direct platinum, which has done quite well.
You think there's new life that's going to be breathed into platinum?
I don't know. They've had a hell of a hard run. It's difficult to say.
Yeah.
Platinum, we're a bit more constructive on the actual metal versus the rest of the basket. And these companies are already kind of pricing in a bit ahead of the run that we've seen. But if you look at past cycles, these things usually run a bit longer than what we've already seen. I don't know. It's a difficult call from here. It kind of feels like it's in the middle somewhere.
I was very excited about that. We'll see where things take us. Gentlemen, I've really pulled out on time here. The clock caught up with us a long time ago. To our audience, thank you for sticking around so very patiently. I think it's been very insightful indeed. So to Nick, Donovan, and Sebastian, thank you so much for joining us this morning. Always grateful for your time and always good insights. And we'll chat to you all again in the very near future.